So this is the question Jhene from the paper one from 2020. It was a section C question 17. So I'm just going to go through the best way, I think, to tackle this question. So let's look at it first of all. So Jhene is the finance director at GAL PLC. As an incentive towards achieving profit growth, the directors receive a bonus. The directors set a target of achieving a 7% increase in profits. Most directors have large shareholding. So let's just remind ourselves, Jhene is a director. He's the finance director. Upon reviewing the draft profit figure for the first half of the year, Jhene has noticed an increase in profitability of 4%. Okay, so that's lower than the 7% they're hoping to achieve. Herbert, the Chief Operating Officer of GAL PLC, who presumably is Jhene's boss, has told Jhene to ensure that the accounts show a 7% increase in profits at the end of the year. And Herbert has suggested the following changes to the accounts. So the first one is to change the depreciation method used on all fixtures and fittings from 20% straight line, which is what they currently use, to 20% reducing balance method. The original cost of the fixtures and fittings was 1.2 million, and the provision for depreciation has got a balance of 480,000 on it. Okay, number two, he suggested that we ignore adjusting for all accrued expenses which have not yet been paid. This includes a substantial amount of staff wages totaling 44,000. And then the third idea is to sell two buildings. They've already received an offer of 850,000 for the buildings, which is higher than they expected them to be worth. The current net book value of the buildings is £800,000. No more information about what the buildings are, where they are, or anything else. Jhene has a long-established relationship with the auditors of GAL PLC. One of the auditors at the company is a close friend of Jhene. He assured that the auditors could allow some adjustments to the accounts in order to achieve the levels of profitability required. However, Jhene is aware of the principles of ethical behaviour in accounting and how it impacts on his role as the accountant. Okay, so though it says that one of the auditors at the company is a close friend of Jhene, it doesn't actually say that that auditor is directly involved with the audit of GAL PLC, but I don't know if we're supposed to infer that from the information given. Anyway, what we've got to do for 25 marks is evaluate whether Jhene should make the suggested changes, so 1, 2 and 3 up here, to the accounts, and your answer should include the associated ethical implications. Now, if you have no idea about what the ethical implications are, so the threats and all the rest of it, and the ethical principles that we need to adhere to, then perhaps go back and have a look at my video on that. But assuming that you're already au fait with those, we'll plough on and see how we can answer this question. So just a reminder there about the 5 steps. We're going to need to establish the facts. We've just looked through those now. We need to think about which ethical principles are potentially compromised. We need to think about the threats to those ethical principles. We need to think about whether there are any internal procedures or safeguards in place to mitigate or reduce the risks, and think about any alternative courses of action that Jhene could take. Okay, so calculations, because it's a 25 marker, we've got some numbers in there. We need to make sure we notch up those AO2 marks doing some basic calculations, and we've examined the facts and we were given some factual figures. So we can do some calculations and think about what impact each of those adjustments is going to have on profit, because obviously at the root of all of this, it's trying to get the profit up from a 4% increase to a 7% increase to make sure that Jhene and everyone else get their bonuses at the end of the year. So the current depreciation works out at £240,000 per annum. It's straight line. So at the moment, that's what they're charging every year for 5 years based on the 1.2 million cost. If we change it to reducing balance, it's done on the net book value. So the depreciation would work out at £144,000. So that would be an increase in profit, because the depreciation would be lower, of £96,000. Okay, future years' profits also will be higher because the reducing balance depreciation, if you remember, just gets lower each year. But we have got an issue in that we will be expected to restate what the profit would have been for the previous years if we change our depreciation policy. So something to be aware of there. Number 2, ignoring the accrued expenses, that's going to increase profit by £44,000 in the current year. But let's not forget that that will reverse itself out next year. So if we don't include the accrual this year, that expense will all land in next year. So it's only going to be a short-term gain. And the profit on disposal, £50,000, is going to be a one-off increase in profit this year. That £50,000 is the difference between the sale price, the £850,000 they've been offered, and the £800,000 new net book value. Okay. So obviously, as I said, a one-off increase in profit this year, but in future years, if we need the buildings, we might have to lease them back. So it may actually end up costing more in the long run if we have to pay rent on those buildings. Okay, so that's the calculations we can do. Let's think about the ethical implications. So which of the ethical principles are compromised? We've got the IOPCP, so in Oxford, penguins can party, or whichever mnemonic you might like to use. People in cars often park. So integrity. Now, most ethical dilemmas do involve some sort of compromise to integrity. So this is being straightforward and honest in all professional and business relationships. So that can also include not making auditors aware of things that you know about that should be included and that haven't been. So definitely Jhene's integrity is compromised here. Also his objectivity, so not allowing bias, conflict of interest or undue influence of others to override professional or business judgments. There's quite a lot of that going on here. Obviously he's got the self-interest, which may be clouding his judgment, so wanting to have a bonus if they increase the profits by 7%. Potentially a perceived threat from the boss, Herbert, whether that's real or just, perceived, that could cloud Jhene's judgment, make him less objective in his decision making. Professional competence and due care, not really on this one. I think it's not quite such an issue with this one. Confidentiality, there's no suggestion that we're broadcasting any confidential information, but professional behaviour. So accountants' behaviour must comply with relevant laws and regulations and avoid bringing the profession into disrepute. I think if we get caught doing these adjustments, and if you remember the Tesco audit scandal from a few years ago where they'd not included, or they had included some income that actually shouldn't have been. They'd accrued for some income that belonged in the following accounting period. And when your shareholders find out about this, then there's obviously going to be some repercussions. And this is a PLC we're dealing with, so we need to take into account, the other stakeholders in this business. So I think if Jhene does go ahead with some of these adjustments, not all, then his professional behaviour could be called into question there. So thinking about the threats to those fundamental principles, self-interest, clearly, Jhene stands to gain a bonus and maybe even an increase in the share price because it says that the directors have large shareholdings as well. I think that's an issue. Self-review, there's no suggestion that Jhene will be checking his own work, so I don't think that's an issue. Familiarity, we've got that long-established relationship with the auditors, so that could be classed as a familiarity threat, and also the friendship of one auditor. Although, as I mentioned earlier, we don't know if the friend of Jhene is directly involved with the audit of GAL PLC. That could be a limitation that we point out. And then intimidation. Remember, this doesn't have to be overt intimidation. It can be a perceived threat. So, Herbert may be making threats about Jhene's promotion prospects, or it could just be that Jhene thinks that this will harm his career if he doesn't do as Herbert has asked. And then advocacy, I don't think that is an issue here either. Right, so internal safeguards. We're going to need to think about what internal safeguards and procedures might exist to reduce the risks. So internal audit, we might have an internal audit department, might pick up the errors. I mean, these are going to be deliberate adjustments or deliberate omissions rather than errors, but we might have internal procedures that will pick those up. Could be that the external audit picks up the errors as well. And also the familiarity threat could be reduced by using a different auditor within the same firm, i.e. not the close friend of Jhene. Okay, structure of the essay then. The way I would deal with this is to take each of the adjustments 1 to 3 and analyse and evaluate it. So start with the calculations that you've done. Don't forget to quote those, otherwise you might not get the marks for them. And then develop that. Make sure you're getting that chain of reasoning. So point 1, changing the depreciation from 240,000 to 144,000. State the impact on profit. It's going to increase it by 96,000 this year, and it will increase profit in future years compared with straight line depreciation. So that might actually help us to give a more accurate value for non-current assets. Most businesses do choose reducing balance depreciation because assets lose more at the start of their life than at the end. Think about the cons. So profit for previous years is going to need to be recalculated, and the value of assets might be overstated. And then, so think about any other potential cons of the proposed course of action there. So I would say things like impinging on accounting concepts, so it's not being consistent. There's no problem with changing the method as long as it does show a more true and fair view. So the auditors may not have a problem with that. I don't think any fundamental principles or threats apply here, really, with point one. It's just a case of changing the method of depreciation and providing it's done for the right reasons, not just to increase the profit, but to give a more accurate value for non-current assets. There shouldn't be an issue. So legal statutory implications with this one, as I said, the accounting concepts, are we being consistent here? And if we're giving a higher profit and a higher asset value, is prudence potentially an issue? Are we showing a true and fair view? And as I said before, no problems with the auditors on that one. Other considerations, the changes may confuse users of the financial statements, so the other stakeholders, but I don't think there's much else to consider with point one. And then you can do the same for point two. So if we're ignoring £44,000 worth of accrued expenses, obviously that's going to bump up our profit this year, but it will reduce it by the same amount in the following year. Think about the pros and cons of the proposed course of action. I don't think there are really any advantages other than bumping up the profit here. Think about the ethical implications. I think objectivity is probably an issue here, professional behaviour and integrity. And that could come about the self-interest threat and the intimidation there as well. As far as the legal and statutory implications go, this is going against the accruals concept, so it's not ideal. I don't think it would be showing a true and fair view. And if the auditors work out that we've missed out the 44,000 of accrued expenses, plus the others, however much they amount to, assuming that they are material, then they will have an issue with this. So there's a danger they'll refuse to sign off the audit report, or they'll qualify the audit report, which again is going to signal alarm bells to shareholders, to stakeholders, that there's an issue. And let's not forget that the directors also have a responsibility to produce accounts that show a true and fair view. So there's a fair bit to write about with that one. And then obviously Jhene's auditor friend could also be in breach of professional ethics if he or she goes along with those proposed adjustments. So if he or she, the auditor friend, knows about these accruals being omitted, then they would be breaching their professional ethics too. So they could be dragged into it. Number three, selling the buildings for more than the net book value. That's going to increase profit by £50,000, but may reduce profit in future if we need those buildings and they're leased back. So we need to think about whether the properties are needed or not. So in the long term, if they're just redundant buildings, then it may well save costs, things like insurance and maintenance and stuff, and release cash. We can do something with that £850,000, maybe use it to pay off loans or invest in new machinery or whatever. But obviously, if the buildings are still needed and we're leasing them back, we're almost certainly going to end up paying more in the long run. No problems with ethical implications, assuming that this is a legitimate transaction at arm's length, that there's no problem, so no conflict of interest. We're not selling the buildings to a director or someone who's associated with a director of the company. None to consider in terms of legal and statutory implications with this one. So we're not doing anything dodgy by the looks of things. It's just about whether we actually need the buildings, and if we do, we probably shouldn't be selling them. That would be the only issue to raise there. So are the buildings being sold for the right reasons? Okay, limitations. Now this is where we have to identify the other things that we need to know. So has Jhene been pressured by Herbert? Is there a real or a perceived intimidation threat? We don't know that at the moment. Does the company need the buildings? So lease back proving very expensive in the long term. Are they surplus to requirements, in which case it will save money on maintenance and insurance and so on. Will the proposed changes lead to the required increase in profitability? We don't know about that yet. This is only the first 6 months worth of accounts. We don't know whether the proposed changes are going to be enough to increase the profitability by 7%. We don't know if this business is seasonal. Is it likely to be better or worse in the second half of the year? That's something else to ask. And what's going to happen to the share price if these errors or deliberate omissions later come to light? So shareholders could force directors to resign, the share price could tumble, could be lots of ramifications. This isn't an exhaustive list by any means, it's just giving you some ideas, the things you can write about, but have a look at the mark scheme. I'll put the link on the information so you can pick the mark scheme up and have a look at that for some more ideas. Okay, so in terms of conclusion, we've been asked to evaluate whether we think Jhene should make the proposed adjustments. I think it's an overwhelming no. I think Jhene should almost certainly not make the adjustments. But you could say that, yep, go ahead, as long as it's properly justified. So I'd be going for something like, adjusting the accounts would go against a number of ethical principles, and we don't know whether or not it will achieve the required 7% increase in profit. Okay, so hopefully that's given you some ideas of how to tackle this question, how to structure it. I haven't obviously put a perfectly formed answer. I'll leave that to you. But good luck with it, and thanks very much for watching.